Welcome back to another episode of Just for Funds here at NASDAQ Market Site. My name is Sang Bu, Head of U.S. Equities and ETPs at NASDAQ. And joining me today, I have John Davey, Founder, CEO, and CIO of Astoria Advisors. So John, there's over 4,000 ETFs today in the market, lots of innovation in the space, innovation in active ETFs. So how should advisors be thinking about evaluating these ETFs and how to find the right fit for their portfolios?
Yeah, so I think you got to be systematic, you got to be rules-based, you got to have a process. So I would say, we follow like a 5-step process. So step one is, are you looking for growth or are you looking for income? That may sound trivial, but sometimes like we look at portfolios and they're trying to solve for income, but you have a bunch of equity ETFs, which doesn't make sense. Step two is, what's your benchmark, right? Are you going to be benchmarked to S&P, ACWI, a combination ACWI Ag? That's step two. Step three is like how much tracking are you willing to take, right? So if you're expecting S&P-like returns, then I would say you have to have more core index-based ETFs. So it wouldn't be a lot of these new funds that keep getting launched, which kind of deviate from the core. Step four is, once you kind of know your tracking error, what you're trying to solve for, how much risk you want to take, then I say, okay, identify where we are in the macro cycle. Are you late cycle, early cycle? Then start to pick and choose your ETFs. Then step five is, I would say, kind of risk management. So, a lot of the new products that I created are like what they call like these hot sauce products that really, if you're looking for growth or income, it's kind of tough for me to say a lot of these products make a lot of sense. So I just think you got to have your rules-based process, and from there it should be self-evident.
Yeah, you talked a little bit about hot sauce products or core versus core products. So how do you weigh between the two, and what are some of your how do you consider the diversifiers for the portfolio?
Yeah, so that's a good question. So I would say if you're trying to solve for a growth portfolio, like moderate growth, 60-70% equities, we like to use core ETFs to have a little bit of factor overlays, kind of like smart beta, let's say. Our alternatives are more tickers like BTAL or gold. So if you look year to date, obviously S&P, NASDAQ's down substantially. A ticker like BTAL is actually up 15-16%. So it's purely inversely correlated. Gold is actually doing pretty well this year. It's up 15-16%. So we really want our alts to be things that kind of cut the left tail risk off, that are real strongly inversely correlated or very low correlated. And a lot of these, kind of hot sauce buffer products, they're not really low correlated. They, will manufacture income by selling vol or buy puts, and they don't really work for a firm like us that's more institutional in nature.
Yeah, that makes sense. And I think the other trend we're seeing is this larger allocation to international equity and the rotation away from domestic equity. So what are interesting things you're seeing in that space, and how do you see the allocation between domestic and international equity?
Well, international works really good in a year like this year. So S&P down 12, NASDAQ down 15, 16. International EFA is flat for the year. EEM is down 2%. So really you own international when you have big market sell-offs and using it for diversification. So we use tickers like IHDG from WisdomTree. We have a little bit of SPDW. And then for international, it's a combination of EEM or DGRE that we use. But we are certainly advocates for owning international, just because we've been saying that the U.S. market is pretty expensive and international is pretty cheap, and so we like to marry the two to balance our risks out.
Yeah, that makes sense. Anything else you think investors are not thinking about? Any opportunities for 25 that you want to highlight?
Well, the economy was clearly slowing before these tariffs were announced, and these tariffs, they're draconian, more so than people's worst, expectations. So that's why we're seeing back-to-back, down 4 or 5% days in S&P. I would say, the administration told you that we were going to go into a detox period. They were trying to reset the economy. So they were warning you that things were going to get, so you needed to be kind of de-risking your portfolio. We began, dynamically managing our risk in February. The economy was clearly slow beforehand. So I would take this opportunity to make sure your portfolio is diversified, own alts. Obviously stagflation is kind of being priced in, so owning real assets make a lot of sense. And the key for a year like this year is just to be very diversified. Mag 7 had a tremendous run the last 2 years, but that's the old market. We're in a new regime.
Yeah, definitely. No, those are really great insights. John, thank you so much for joining us, and thank you. It's been another episode of Just for Funds. Thank you.